With the pension freedom reforms coming into force in a matter of weeks, it has never been more important to make sure a client's retirement income investment journey is well funded and carefully planned out. We spoke to financial planning veteran and cash flow planning pioneer Paul Etheridge to discuss the key planning issues involved. But first, let's hear what other advisors have to say on the topic.
The investment proposition won't actually change based on the fact that it's retirement income, and the reason for that is because in our view our portfolios are very well constructed and robust. They consist of about 9,000 different assets, and what we do for our clients is we mix those portfolios between growth assets and defensive assets, and during the year we'll be withdrawing the income that they require, or withdrawals as we would call it, from the defensive part of the portfolio, and therefore at the end of the year we will just simply have a rebalance with the clients, and that will moderate their portfolio and get it back to where we wanted it to be.
Principally, I'm very passive in my approach, and the reason for that is that I have a strong view about taking the process back to basics and having a relationship with clients in terms of the planning, and being what we're principally good at from a financial planner's point of view.
The point for us is that retirement income planning isn't necessarily just about pensions. So in reality, cash flow, in my view, needs to be used with all clients in order that we can manage their lifestyle in retirement. So the reality of it is whether it's a pension, ISAs, mix of all different tax wrappers, it's irrelevant. And cash flow is the thing that every financial planner in my view should be doing in order to make sure that the clients know how their wealth in retirement is going to pan out.
Yes, we use cash flow forecasting tools. Originally we were using the module that existed within the selector pension, which we use principally for our comparison purposes, which was fine, it did the job, but going into the new environment of the new pension freedoms, we needed to be a bit more aware of a tool that was a bit more practical for use. So after an awful lot of research, and even considering doing it ourselves, we started to use CashCalc, which is a very, very well-designed product. And it's from a business perspective, it's actually incredibly cost effective as well.
So Paul, how important is lifelong cash flow modelling to decumulation investment planning?
Well, it's essential for any form of planning, decumulation, accumulation, anything you like, because if you don't use this as a major part of the process, all you can do is guess.
So what are the specific issues under the upcoming pension freedoms that can be dealt with through using a cash flow plan?
Well, it doesn't change anything fundamentally, Will. All the time we're trying to have a clear understanding of where clients want to go. What do they want out of their life? And it's as broad as that.
For an average client coming into retirement now, generally speaking, what are going to be the big issues in their sort of next few years of decumulation that they need advice?
Yep. The big issues are going to be, are they going to run out of capital in their normal way of living? Are they going to run out of capital even quicker if they have bad health? Are they going to run out of capital if they need to help their children and grandchildren? And what I tend to do is, let's just imagine a family where their son or daughter has just come down from the university. I tend to ask the client to explain to me what are the issues that they're going to meet. I don't say they are going to meet these issues.
In terms of investment, for example, how did the assumptions, some of the conclusions you come to through a plan like that, affect the way that the main client invests their money, presumably to produce an income to sustain their lifestyle, notwithstanding whether they buy an annuity or not?
No, what they want is money. Whether it's income or capital doesn't matter. And I think that if you have 100 advisors sitting here talking about the subject of investment, you'll have 100 different answers.
With a cash flow plan, how are you able to adequately prepare and account for those risks where there are, of course, certain unknowns?
Well, we can account for them by having a separate scenario for each of the major potential problems. For example, we always have one of the scenarios is if you had been disabled yesterday and in need of long-term care, let's look at the numbers because they're scary. Now, you can choose, some clients will choose, say, well, okay, but I'm prepared to take that risk. I know I can't buy insurance cover for it anymore, so let's take it out of the listing. We'll concentrate on the assumption that we're going to be all right in terms of health. Others will say, yeah, no, it's the worst thing that could happen. So I've got to keep more money for that I can't then give away. And this is one of the points which I think I've mentioned to you once, that for people at this stage in terms of decumulation, some people, for the first time in their lives, are seriously considering renting a house. Because if they've got some hundreds of thousands of pounds that has just become liquid, it's very nice to have it liquid. And why not rent? If you've then got £500 million or whatever it might be behind you, and you've got peace of mind. And peace of mind is a major part of financial planning. Our clients should have peace of mind. They should look forward to coming to their planning meetings. They should be smiling when they leave the room, and we can all pick up all these other things around. And in practice, it's easy.
Well, Paul, thank you very much for coming in. You can download this week's crib sheet at citywire.co.uk/advisor know-how or bnymelonam.co.uk/advisor know-how, or you can find the link at advisor know-how on Twitter.